But I guess before we start, I'd just like to introduce myself. My name is Liam. I'm a member of the client services team. I'm here today and I'm joined by one of our chartered accountants, Jamie McHugh. Good morning, Jamie.
Good morning, Liam, and thank you for joining us, everyone.
So I guess we'll kick it off. Sure, I think there's a few joining. Today, Jamie will talk through the most commonly asked questions we get from early stage entrepreneurs, as well as provide direction on some key areas to consider. Um, I guess firstly, I'd like to just give you an insight about Knorr. We're an award-winning accountancy and company secretarial practice with a team of almost 100 professionals. We work with approximately 2,500 businesses across Ireland and the UK, supporting everyone from high potential startups to established SMEs with practical, proactive advice that helps you grow with confidence. So we offer bookkeeping, we've payroll and compliance with transparent fixed monthly pricing to suit businesses at every stage. So before we dive into it, just a quick note. I suppose everything we cover today is for general information purposes only and should not be construed as advice. Every business is a little different. So for anything specific to your situation, your accountant is always the best person to ask. And if you don't have an accountant in place, we'd love to help. So just drop us a line at hello@Knorr. As well as that, if anything comes up as we go, pop it into the chat or hang on to it for our live Q&A at the end, and we'll get through as many questions as we can. So just put across. So just to, I suppose, run through what we'll cover. We're assuming that you've either set up your business or you're about to do so. And we're not going to cover the basics of incorporation or your annual return date or your tax registrations, such as income tax, corporation tax, and VAT registration. So it's assumed you already know that part. And if you don't, you can watch our old formatted startup webinar recording, which covers all, I suppose, this in more detail. And I'll add a link to this in the chat for you now. But just to run through what we will cover, the things that catch founders out and the reliefs that most people never hear about until it's too late to claim them. So today we'll cover, as you can see, paying yourself properly and avoiding the traps, expenses that actually hold up to revenue scrutiny, bookkeeping that protects you, not just ticks a box. Then we have Shore Relief, which we'll touch on in some detail, turning your old PAYE tax into startup capital. And as well as that, then just touching on R&D tax credits. So who actually qualifies, and it is broader than you think. And as well as that, just directors' legal duties and what happens when they're ignored. So I guess we'll just start with, how do I pay myself properly? And most people know it's salary or dividends, but where do founders actually get this wrong? And I might throw it across to you, Jamie, for that.
Thanks very much, Liam. So paying yourself a salary through payroll is a deductible company expense, which means that it can be set against a company's profits to reduce its corporation tax bill. The correct personal tax on your salary is paid in real time through the pay as you earn system. So anyone who's been on payroll previously will know what happens there when you get your net wages on your payslip. Okay. Dividends, on the other hand, are paid from after-tax profits, and they have a flat rate of 25% tax withheld at the point of payment and paid to revenue as a down payment against your personal tax return. Okay. In most cases, it is much more tax efficient, especially in the early years of a business, to choose salary over dividends. Okay. But here is where founders usually trip up. Okay. Paying yourself before payroll is registered. Okay, so the company needs to register for payroll taxes with revenue before you can make any payments to your staff or to yourself. Okay, we see this constantly. For instance, a director takes a few quid out of the business in the first month before the registration is sorted, or they receive company income into their personal bank account, assuming that they'll square it later. Okay, revenue don't see it that way. Any payment to a director for work done is employment income from day one, whether or not payroll exists. Okay, so sort payroll registration before the first payment, not afterwards. Okay. The next issue that we see commonly is mixing dividends and salary without planning the tax year. Okay, so dividends are taxed in your personal tax returns for the year in which they're paid at your marginal rate of tax. And there's no PRSI relief available that you can get, say, with pension contributions. If you take a large dividend in a year and your personal income is already high through other sources of income like PAYE, then you will likely pay tax at 40% plus USC and PRSI on top of that, when really what you could do is spreading that dividend across multiple years or taking salary with a pension contribution instead would mean a materially smaller tax bill. Okay. For certain reliefs also like sure relief or R&D tax credits, which we'll cover later, paying yourself through payroll is either required or is much more advantageous depending on your circumstances. So planning this from day one can make a big difference to multiple elements of your startup and its cash flow. Okay. The last issue I want to cover in this part is treating directors' loans casually. Okay. So if you take money out of the company that isn't structured as salary or a dividend or properly documented loan, revenue can treat it as either a benefit in kind or an undeclared dividend or undeclared net wages, with tax consequences that are far worse than if you just paid yourself a salary in the first place. Okay, a director's loan account needs to be tracked formally. What's owed to whom and over what period, not just left as a running balance that nobody looks at until year end.
Brilliant, Jamie. That's very informative there as well. And thanks so much for that.
Mhm.
So just to run across then to expenses. So I know this will be a hot topic for a lot of directors, especially starting off. There can be a lot of expenses. So most founders know the wholly and exclusively rule. What's the nuances maybe that catch people out?
Okay, so for those who don't know the wholly and exclusively rule, the standard test is this expense wholly and exclusively for the business? Is it necessary to incur this expense to carry on the trade? And would you have incurred that expense anyway if the business didn't exist? Okay, so there's a few points I want to run through here about the what people try to claim that is not a good idea, and a few expenses that people don't know about that you can claim. Okay, so the first one is home office costs. Okay, so for a company, as an employee through payroll, you can claim €3.20 per working day tax-free if you're working from home, paid, as I say, through payroll to cover heat, electricity, and similar home office costs. Okay, so there are no receipts required for this specific amount. But if you have fixed costs like broadband that don't change because of the business, that would not be claimable because you'd have paid for the broadband anyway. Okay, whether or not you work from home. Home office rent is essentially a trap, not an opportunity. Okay, so don't claim rent on a home that you own as a business expense because it can expose you to personal income tax on the notional rental income and will complicate your capital gains tax if you sell the property later. The administrative saving that you'd make in the short term is rarely worth the long term cost. Okay. Benefits in kind, which we would call BIK, are often misunderstood as free payments from the company. Okay, so a company can pay for health insurance, a company car, training, or memberships on behalf of directors or employees. But in many cases, these are treated as effectively gross salary, a benefit in kind, in other words, and you will be taxed accordingly through payroll for the value of those benefits. That doesn't mean that it's not worth doing. Okay, they still often save tax overall versus paying sort of saving personally out of your net income after tax. But you should go in with eyes open on what the actual after tax saving is, rather than assuming it's a free perk. Okay? Now, what a lot of people are not aware of is that there is something called the small gift exemption, which is an underused, fully tax-free benefit. Okay? A company can give each employee registered on payroll, including a director in shareholding, up to 1,500 a year in small gifts, completely tax-free. However, these gifts need to be non-cash and they are generally in the form of one-for-all vouchers or prepaid cards would be most common. Okay, this is one of the very few genuinely tax-free benefits available, and it is surprising how many companies we see coming through who are not aware of it and are using it.
Very good. Yeah, it seems like a lot of people wouldn't be aware of that, so I think it's really useful to highlight all of that. Um, I guess we'll move across then. Bookkeeping is such an important aspect to really start off on as well, and not be kind of chasing your tail a bit. So everyone is told, to use the likes of Zero or any other similar cloud tools. But what does good bookkeeping actually protect you against?
Right. Okay. No, this is a vital point, Liam. It really is. And it's the one thing that I would really advise any company starting off to get right from day one. Okay. Without clean bookkeeping from the very start, you are going to lack visibility on future cash flow, upcoming liabilities, data around how long it takes customers to pay you, and other vital information that you need to run your business. Okay. Speaking from experience, I have seen a lot of profitable startups, like really profitable, with really potential to the next step of standing business. Um, I've watched them go under from cash flow problems that should have been first averted with simple, solid bookkeeping and record keeping from the get-go. Okay. So bookkeeping is the single biggest driver of unexpected tax bills, particularly. So the classic example is a director uses a personal account to receive early sales before the business account is open and forgets to formally transfer those funds and flag them to their accountant. And you end up with a tangle of personal income and company income that takes hours and additional fees to untangle and can trigger tax consequences that wouldn't have arisen if you had correctly accounted for these in the first place. Okay. Clean data as well is vital for claiming VAT and other tax reliefs from revenue. Okay. If you're a VAT registered business, invoices from your suppliers that are missing required details such as your company's name, the VAT number for the company, the date of the invoice, and so on, they are generally not eligible for VAT reclaim. So it costs nothing to get this right from the start. So if you have already started making purchases for your company, I'd strongly advise you to double check that your invoices have the right details on them. And if they don't, you can go to your suppliers and ask them to reissue them with the correct details. Okay. Next, I want to talk a little about management accounts and statutory accounts, what these are and how to tell the difference and what different uses they have. Okay, so statutory accounts, also known as financial statements, okay, are a compliance requirement for a company. They are produced once a year for filing with the CRO, but they're not really a useful tool for day-to-day decision making. Okay, management accounts, on the other hand, are produced monthly or quarterly for business owners to actually run their business. Okay. They consist of a series of relevant reports for you to see profitability, margin, cash runway, any other metrics that you need to track to see if your business is meeting the targets. Okay. Most growing companies only ever see the statutory set at the end of the year, and either they can make decisions based on that out of their consistency, or they often provide cash levels in advance to guess if they're profitable. In reality, there's a large set of liabilities coming up, particularly tax, that they haven't considered because they're operating only on a cash basis. Okay. So timely and accurate reporting through management accounts based on accurate bookkeeping details is a key element of running a successful business and knowing what the future holds for your company. Okay. It's also good to note while we're on the topic of management accounts that banks will often request a set of management accounts either for a company loan. Obviously, they'll want to have up-to-date information about how the company is doing, but also for personal loans like mortgages. Once the bank finds out that you're a director of a company and that's your major source of income, they're going to look for management accounts for the company, because that is going to tell them how well are you going to be able to keep up with your loan payments. Okay, so it's always good to be aware of that when you're heading towards buying a house, because this is the last step and is mentioned very late in the process by banks quite regularly. I'd recommend that you double check with them in advance what documentation they will need in the circumstance where your main source of income is from the company. Okay.
Brilliant. And it really shows the importance of good bookkeeping there. So thanks for that, Jamie.
Sure.
It brings us to our next topic, which is sure relief, and so turning old PAYE tax into startup capital. This is one I think that every entrepreneur wants to claim. So it's so important to know, how do I qualify?
For sure. This is a fantastic relief that's available to help early stage startups get the cash flow they need to go on and become successful businesses in their own right. Okay. So the way that it works is that it lets you claim back income tax that you have already paid in previous years through PAYE as a refund, okay, to help fund your new company. It's effectively the state handing back tax paid previously to you to support the need into self-employment. Okay, how does it work? And what can you get out of it, I suppose, is the most important point. So the relief can lead to a maximum of 50% cash back from revenue for every €1 that you invest into the company. Okay, so you must be able to directly pay cash into the company in exchange for new share capital. Okay, the amount of the refund that is available to you will depend on the level of tax that you have paid through employment previously. Okay, so the more tax you have paid at higher rates, the more you could benefit from sure relief. You can select also the most advantageous tax year to claim relief against out of the current year or the most recent previous 6 years. So there's a lot of flexibility there to get the most out of this relief. Okay, so who qualifies? Okay, as I mentioned, you must have had mainly PAYE income over the previous 4 years. You must take up full-time employment in the new company, either as a director or as an employee within a specified time period. You must invest cash, not transfer of assets or similar, in exchange for new shares in the company. You have to hold those shares for at least 4 years. If you sell them early or otherwise dispose of these early, it can trigger a clawback of any relief that you do get. Okay. The minimum investment is €250. And there are annual and overall caps on how much can be claimed. Obviously, for most people doing this relief and going for it will be investing quite a lot more than that, but the minimum at least is 250. And finally, the company must be carrying on a genuinely new qualifying trade. So certain activities, like most professional services, dealing in land, forestry, or speculative trading, for instance, don't qualify. And also, if you carry on, say, a business through a company that you previously had as a sole trade, or if it's really very close to a continuation of an employment you had previously and you're working for your old company, but just through a company setup, that also won't qualify. Okay. So where do founders get caught out in going for sure relief? Okay. So the mainly PAYE test catches a lot of people out because it looks at your total income over the previous 4 years, not just the most recent job. Okay, so if you had a mix of PAYE and say significant self-employed income or significant investment income, then the eligibility can get complicated very quickly. It's really worth checking this out with an accountant before you assume that you can qualify for this relief. It's good to note also that if you have multiple people who are directors or employees in the business looking to take advantage of sure relief, that each of these people can claim independently, but each of them will have to separately meet all of the eligibility requirements. will have to each individually invest their own cash for new shares, and everyone's position will have to stand on its own. Just because one person will qualify does not mean that everybody else will. Okay. And finally, the cash must be invested for new shares in the company. Okay. In some cases, it is possible to convert maybe a loan from a director for, say, cash previously added in or for payments made on behalf of the company. But this process is much longer and incurs a lot more costs. It has to be signed off by a registered auditor, for instance. So it is much simpler and easier to plan ahead and to pay directly for the shares with cash.
Brilliant, Jamie. Thanks so much for that. And I think it's
No
it's so
problem.
important for new founders, as you touched on there.
Yeah.
So it brings us to our next slide here. So R&D tax credits, and it's broader than you think. So people hear R&D tax credit and assume it's only for labs and tech companies. But is that true, Jamie? Or could you give us some
No,
insight
no,
there?
it isn't. I mean, that's the typical picture people get when you hear the words research and development, isn't it? But this is one of the most misunderstood reliefs in the whole tax system. And it's not just limited to people in white coats, right, in the labs. So maybe I'll just give you an overview of the headline numbers first. So the credit is currently worth 35% of qualifying R&D expenditure. And that is on top of the normal corporation tax deduction of 12.5% that you would get for the same costs that you spend on. So effectively, the benefit is around 47.5% of what you spend, which is huge. It's a huge incentive. Okay, it's available to any company that carries on qualifying R&D activity in Ireland, in the EEA, or in the UK. Okay, regardless of the size or the sector that you work in. And crucially, it's available even if the company is loss making or pre-revenue. Okay, so what revenue will allow you to do is that 35%, they will allow you to claim that back as a direct cash refund, even if you've never paid commissions on sales. Okay, so what actually qualifies as research and development for this relief? The legal test, according to the legislation, is systematic, investigative, or experimental activity in the field of science or technology. Okay, this work must be aimed at resolving a scientific or technological uncertainty. Okay, so what can this include? It could be, for instance, a software company building a genuinely novel technical solution, but not just configuring existing tools to meet their specific needs. It could be a manufacturer, for instance, working through unsuccessful production trials to solve a technical problem. Okay, it could be a food or drinks business developing a new formulation or a new process that requires genuine technical trial and error. Okay, or for example, it could be an engineering firm solving a problem where the answer wasn't already known readily available. Okay, really important to stress that it is not routine troubleshooting, configuration of off-the-shelf systems for your own use, or work where the answer was already known. The bar is general technical uncertainty, not just we build something new to sort our own particular process, but it's not very different from what other people are doing. Having said all of that, what usually catches people out is not so much whether or not they're eligible, it's that they haven't done the administration right. Okay, so if this is the first claim, or you haven't claimed in the last 3 years, for instance, you must file with revenue a filing notification at least 90 days before submitting a claim. Okay, if you miss that window and you cannot, then that claim is gone. No matter how well documented the work is, no matter how perfect your technical assessment is, that one deadline fetches out more genuine claims than any other issue. Okay. The real win, of course, for this relief is the cash flow that it allows them to generate. So companies can now claim up to, I think, 87,500 of a claim paid out in full in year one. Okay, with the balance of any additional spend in that year staggered over 2 further years. Okay, this was specifically increased to help small and medium enterprises and startups with their cash flow. So if you're a young company funding R&D out of tight cash reserves, This can be the difference between funding the next phase yourself or having to go for external funding. Okay, so it really does make a big difference if that is what stage you're at. Okay, and just to link in with what we said previously as well, it's much better to start recording all of your details for this now rather than in 6 months' time or after year end. Okay, so project descriptions, setting out the technical uncertainty being addressed, what approach you're taking, the different stages that you would expect to reach, milestones, that kind of thing, and then the expected outcome. Okay, time records for staff involved. These are all things that you'll want to have tracked at this time that you are doing the work. Having contemporaneous records is absolutely vital for this relief. When revenue come to look at your records, they will expect to see it with timestamps almost, or with some evidence that it was done on a periodic stage throughout the year, rather than all just being done in one document at the end of the year, kind of like a write-up at the end. They'll expect it to be done at the time. Okay, so that's why we really emphasize that this ties in with bookkeeping, because doing the records on a monthly basis and having the costs written in really helps you to create those reports that you need for revenue in the case that they will have a look at your R&D claim after the fact. Okay.
Brilliant. No, thanks for that, Jamie. It really does show that kind of connection with good bookkeeping as well, which I'm sure a lot of people will definitely consider. It brings us to our next point. So director's duties and what you're legally on the hook for. I'm sure people know about CRO and revenue filing deadlines, but is there other things that they might know while being a director?
Yeah, so being a director is not just a job title you take when you start up a new company, right? Under the Companies Act, it comes with personal legal duties, and breaching them can carry personal consequences, even if the company is a separate legal entity, right, with limited liability. So, loans to directors in particular are highly restricted. We did mention earlier already that there are good tax reasons to avoid taking a loan from the company, but separately, loans such as those, or even guarantees on personal loans using company assets, are severely restricted under the Companies Act. Okay, if you were thinking of doing this, please talk to your accountant in advance to make sure you follow the correct procedures and treatments. Okay. The accuracy of file statutory accounts is also something that is a direct personal responsibility of the directors. So when approving annual financial statements, all directors, not just one who's listed as a director, are responsible for the accuracy of the. Okay. Practically, this means that the company secretary, their job essentially stops at making sure that the company is compliant with the CRO, making the filings and so on. But the director's duties are much, much deeper than that. It's a personal legal standard that you're held to, regardless of how good your secretary is, how good your accountant is. The buck stops with you. Okay. So if you're ever unsure about whether a decision or a situation crosses a line, right, in breach of the Companies Act or not, particularly around the cash flow of the company or loans to yourself or a conflict of interest, that's a conversation you should have with your accountant or solicitor before you act, not afterwards. Okay. And then there's the final thing I want to touch on here, that most founders are not aware of this one. As a director of a company, you have an obligation to act when the company can't pay its debts in the interest of the company's creditors. Okay. So if the company becomes insolvent, by which we mean unable to pay its debts as they fall due, okay, then the directors have a positive, active legal duty to act in the interest of those that the company owes money to, not just its shareholders, from the point at which it becomes obvious that cash flow is going to become a problem. Okay. Continuing to trade and to take on new debt and new business while insolvent without taking appropriate advice and seeing what the company can and can't meet, it's the kind of decision that can expose you to personal legal action. Okay, so do be aware of that.
Thanks so much for that, Jamie. So much information
Sure.
there, and I think it's so important for new entrepreneurs starting out. So I really appreciate that. So that brings us to, I suppose, the end of those points that we had planned to cover. And before we do move into our Q&A, just wanted to flag something that's probably directly relevant to a lot of you on this call today, or will soon be relevant if you're planning on setting up your business. So tomorrow morning we have a free 30-minute webinar at 10:30 on director pensions. And if you're a director of an Irish company, I think this one will definitely be worth your time. So we have Tom Francis, our head of accounting, is covering the pension and payroll mistakes that are costing Irish directors money right now. So things like whether your PRSI classification is actually correct and how company pension contributions can be one of the most tax efficient tools available to you as a director. So I'll make sure to drop that registration link in the chat as well. But it'll also be included in the recording email that you'll receive after today's session. So that's everything here. So I'll just take a quick look to see if there is any questions at the moment, and I'll fire them across to you, Jamie.
That's good.
So there's one here that says, I've already incorporated, but haven't made my share investment yet. Is it too late for sure?
Oh, okay. So in this situation, somebody has already set up the company, has already got some shares issued at the point of incorporation, but wants to make a further investment in shares. It's absolutely not too late, but the timing does matter. Okay, so the investment needs to be in new shares issued for cash. That can be post incorporation additional shares, and the most important thing is that you would at this point make sure that you have met the other requirements. Is the company and carrying on a qualifying trade? Do you have the personal PAYE history to make this a viable investment? And most importantly, are you taking on employment within the company on a full-time basis usually within the next 12 months for a 12-month period? Okay, so it's vital to make sure that you double check all of those points. And I would recommend reaching out to an advisor to make sure that you're in the right space and within the right timelines, particularly to be able to plan this correctly going forward. Yeah, but it's not too late if you've set up the company, you're within the first couple of years, you can usually make a further investment for new shares. And yeah, that would be eligible, assuming you meet all the other points.
Brilliant. Okay, thanks for that.
Sure.
And there's just another question here as well. So
Okay.
can I claim the R&D credit for work my own staff did, or does it need to be outsourced to a lab or university?
Okay, so this is an interesting question. The R&D tax credit, it's quite broad, as we mentioned above, more broad than people would realize. Most of the work ideally will be done internally by your own staff, actually, not the other way around. So there are restrictions to how much credit you can claim if all or most of the work is done outside of the company by external consultants or an external laboratory. It should ideally at least be matched by internal spend on wages or on buying in raw materials and that kind of thing. So you can absolutely outsource to a lab or university, but the internal spend is actually much easier to verify and to be in control of, and to write up the notes particularly for what revenue would be looking for on a random compliance check. So I would, yeah, absolutely. If you want to outsource, you can, but you have to carefully match that against internal spend as well. So again, speaking with an accountant in advance who knows their R&D would be the first step on that one, to make sure that before you make the big spend, that you're actually spending it in the right place without assuming that you'll qualify for the R&D.
Okay, that's very interesting. And I suppose it just shows the value of reaching out to your accountant on that as well. But that is all of our questions for today. So just want to thank all of our attendees for your time. You'll all receive a copy of this webinar after today, and we'd love to hear from you if we can support your business in the future. But for us, I guess that's everything, and have a great rest of your week.
Yep. Thanks, everyone. Appreciate it.